Hey everyone, time for another weekly review. And this week we'll talk a lot about bonds. We have next week a very busy schedule. Let's mention the biggest one. So we have the Treasury refunding announcements, where the Treasury announces what bonds they will issue during the next quarter, the details of that. This announcement on Monday is just about the net issuance. It won't go into detail, and we have on Wednesday the details of what that will be. Then we have the FOMC, and another looming quote-unquote threat is the JPY intervention from the Bank of Japan. JPY went crazy on Friday and reached 1.58, a bit higher than that. They have verbally threatened an intervention and set the line in the sand at 160. We are very close to that. We'll see if they do anything. But before we get into other stuff, let's talk about the Treasury announcement. So last quarter, they had a net issuance of 760 billion. And at the last QRA announcement, they forecasted Q2 to have a net issuance of 202. So you see here, this is net, meaning there are always treasuries that reach maturity and they roll off. This doesn't mean they will create new treasuries to this amount. It means it's the net. So some will reach maturity and they will just roll off, and they buy up usually more than they reach maturity. And this is a chart of what they issued. This is not net, this is just what they issued, and you can see that they issued a lot. Historically speaking, there are three, in general, they should not be issuing this many bills. There are three type of treasuries: bills with a maturity of up to 1 year. Then we have notes, which is 2 years up to 10 years, and we have bonds, which is the 20-year and the 30-year. And as you can see, we've had a lot of bills lately, and bills are stimulative because they have some this short maturity, like up to 1 year. They uh, stimulate the economy when they are issued, and historically, this is not the correct type of uh, debt issuance. They should be issuing more bonds and a lot less bills. But last time they did this is when they tried to issue more bonds was in October. And this is what happened. When we bought them here at the end of October, it was because Yellen announced that they changed their uh, debt profile, and they said they would be issuing a lot more bills than bonds. And this is what it created. Now, next quarter is based on the last estimates, one where we have negative bill issuance, meaning they will still issue bills, but a lot more will roll off. And it's a quarter where we have a net issuance that is relatively small compared to what we had in the past quarters when it was closer to this than this. So this should be a negative for liquidity. And negative for liquidity means negative for stocks. On Monday, they announce if this 202 number is still their target. We shall see. And we will find out on Wednesday if the bill issuance is still negative, which again is theoretically bad for stocks. Uh, that's one of the reasons why I quit on TLT, and I'm waiting to see what happens. If they announce that they issue more bonds, we should see long-term yields skyrocket and go to above 5, like for the 20-year. Maybe we hit even this. We shall see. Secondly, USD JPY. And let's add DXY, just obviously correlated because DXY contains USD JPY in a bit. We have oil, CL. We have what the fuck am I doing? Oh, my bad. USD JPY. Okay. Then I want to add oil. And I want to add US 10-year. Well, first of all, we can see that the 10-year is very highly correlated with 10 years in yellow, very highly correlated with USD JPY. Let me turn the other stuff off. Correlation is very high. USD JPY spiked on Friday and we didn't get the corresponding move. The logic here is that if we get a JPY intervention, the Bank of Japan will supposedly be selling these bonds and treasuries and all types, doesn't matter, and this will make yield spike. But we have empirical evidence that this is not the case. When USD JPY goes down, bonds go down as well. So what's the deal here? Uh, I honestly don't know. What we can see with the naked eye is that everything is correlated. So if we have a JPY intervention, that should actually be good for risk assets. It should bring DXY down, it should bring oil down, it should bring bond yields down. So the much feared JPY intervention is probably gonna be good for risk assets somehow. I don't know. Again, I don't understand why, but the correlation is visible. Unless this correlation breaks, maybe we get a breakdown of the correlation, and we actually get what people are saying will happen, meaning that if we had a JPY intervention, there will be a sell-off in US bonds and Treasury will spike even harder because they will be selling US bonds to fund their JPY intervention. So that's the second thing. Now, all this being said, stocks look weak. We didn't really have a breadth trust kind of thing. We had a crossover, but it looks weak. Like this is curling down. The short-term line versus the longer-term line is curling down again, and it's looking like we will have another negative crossover. Like this will do this, something like this. Then we have the other breadth indicator, which didn't go too high on this move up, and again, it's not shooting up straight. It's just curling a bit. We have the McClellan oscillator, and we barely crossed into positive, and another leg down can come without any issues. The U-vol on Friday was like 60 something, so not very strong. This pattern here in which it hugs the upward trend line, this can be bullish, this can be bearish. We have kind of like a rising wedge here, which is usually a bearish pattern, but if we can have an upside breakout as well, it's going to be event based. So kind of the uh, unusually bearish situation after the rebound we had on Google earnings. I don't like that Bitcoin is relatively weak. Like it didn't rally on Friday with stocks. We had a net ATH move up yesterday and today, but Bitcoin was kind of muted. So I don't know what to say about this. All of this. I'm getting bearish vibes from the market, but that may be just the market wants to wait and see what's going to happen with the QRA and the bond issuance. But from that aspect alone, the fact that we're only getting quote unquote 200 billion for next quarter for Q2 is not going to be helpful for stocks. We shall see how this plays out. But I'm kind of sticking to this for now, meaning we will kind of hug this area until we get direction. Once we get direction, we either drop hard and do an attempt to make new lows, or we break out and go crazy again up to the recent top. I don't think we. What the fuck did I do? Up to 523, the recent top. I don't see us going higher than this in this current leg up. So this leg up might not be a big one, and we still have the situation where we go to the low AVWAP. Low retest, maybe we bounce here, but to this 485 area. And this should happen by OPEX if it does. Same on the way up, this should happen by OPEX if it does. OPEX is on the 17th next month. So probably the target for a move up is the 15. If we survive this week without making new lows, I think we will get the upside scenario. Meaning, doesn't mean we don't go down at all for any of the events this week. But if we survive with a hold here, uh, I think we see this 523 by OPEX because there's not really any negative events until maybe next CPI. I expect the FOMC to be more of a nothing burger. Like they will say they are concerned about the recent spike in inflation, blah 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 blah, but the JPY will still be dovish. The only thing that the market can react negatively to is a JPY intervention or the QRA announcement if it's not to the market's liking. But I would expect, given that we just had a correction, uh, Miss Yellen will be very accommodative of what happened and the fact that we are in a correction and adjust the QRA, the treasury uh, coupon issuance a bit, and the market will like that, and we get this scenario here. But again, this week can be a bit can give us more downside quite easily. But if we don't end the week lower than this level, meaning we keep the uptrend, so 502. If we end the week above 500, I think there's a good chance we get a rally in the next couple of weeks and continue going up, potentially even until the 17th. After the 17th, things get a bit dicey, but yeah, we shall see how that plays out. So this is my line in the sand. If we close the week below this, it's bad, and most likely we get the bearish scenario and continue going lower. If we end the week higher than this, we get the bullish scenario, and the target is the recent high here between 523 and what's this, 525-ish. Another thing to look out for is the CPX levels. So on SPX, 5100 is a very big level. We closed the week virtually at it, slightly below it. So when we look at levels, this one is more important than whatever SPY is. It's not exact correlation between SPY. So this was, let's say, 5100 and SPY was 508. The 5100 level on SPX is more important than the level on SPY. And it's a combo. If you put on moving averages, this was the 20 MA. Basically, we got a 20 MA rejection at 516, 5116. We have the 50 MA above. So how it will play out most likely if we get a rejection move is we will probably gap up on Monday up to the 50 MA. It will look like we break out above the 50 MA, and somehow Brett will be bad There, this one. Breadth will be weak, like 40%, 50% on UVol, and we get a rejection that takes us all the way to this. And that's going to be slightly below 500. But if we save it, it's bullish. It would be like a triple test, a triple attempt to go lower, and that gets bought up, and we go back towards the highs, something like this. This will be the bullish berry scenario. But if we close below this, maybe even go as low as this, we shall see. That's about it for this week. Hope you guys enjoyed it. Have a good one. Bye bye.